with the first page first, okay? Your student ID, name, all the details.
Don't start working. So give this paper in half.
All right. First page, yeah. Yeah. Paragraph 2 from this.
Keep one.
They are working with. Don't got the paper. Don't got the paper sheet. 1, 2. Yeah. I need 3 more papers.
Anyone needs any working sheet? Working sheet?
Your working sheet.
Can you pass at your back? Working sheet? Keep one. If there is no enough, pass at the back.
Who needs the question paper? Just put your hand.
Working
Question
paper.
paper here, okay?
It's coming. It's up there
You
in
have
the
the
middle.
question paper?
Yeah, this.
All right. You need working sheet, all right? All right.
The green rough paper. Yeah, it's coming. It's in the middle. It's coming. Okay, you wait. Just come. Here, come. No, just paper, please.
Yeah. All right.
They all need this.
You should not look at the questions now. Just fill up the first page only. Right, formula. You don't want to tear it off. Okay?
All right. All of you have got your question paper and the green working paper. Now the green working paper for your rough calculation or any other rough work you want to do. But remember, you have to return it with your script as well. That's not marked for sure, but you have to return it. Now your 5 minutes will start soon. I will open up online timer here, and then your 5 minute will start from there. I haven't announced the 5 minute yet, so just give me a minute. As you all know, it's a 75-minute test plus 5 minutes reading time. So altogether 80 minutes test. And your reading time starts now. So make sure you don't write anything, only reading. Don't use your pen. Only reading.
Okay. Okay. Shall we start? No? At least you look happy after the test, so that's a good sign. I know that it's sort of the worst time to deliver the lecture, right? You don't want to see me at this time because you just want to go home. Because you're so happy. At least you finished the test and it's Friday and I know that you just want to go home. At least you want to do something better rather than staying here and listen to me. But it's going to be only 1 hour. So at least I'm not going to let you suffer for longer than that. So just bear with me for the next 1 hour and 10 minutes. And hopefully, because we need to cover all of the content, and the cost of capital lecture is really important. And you learned it last week, so today I'm going to go through the tutorial solutions with you, so at least you have an idea of how to deal with that question. If you happen to see that in your exam, it's an important one, so even if it doesn't appear on the exam, it's still important for you to know, right? And after that, I'm going to spend around 25-30 minutes on the lecture. So it's going to be very short lecture. It's very brief one, but it prepares you for the next lecture. So the next one, capital structure, is a very hard one. So hopefully you are prepared from this lecture, and the next one you will feel a bit better. But the next one will be a bit hard for you. Okay. Just to let you know that after finishing marking, because I'm not going to be in class until week 12, so I will be here this week, and then I will be back in week 12. So basically, when I finish marking, I will upload the marks online. I let you know when it is available, hopefully after the break. So hopefully at the beginning of October, you will see the result. And then I will arrange the viewing session for you. So of course, you can go to the viewing session, look at your test, and check the marks again, see where you didn't understand, where you didn't do it very correctly. And then, of course, you can always ask me how to deal with the questions, right? And hopefully you see that... No, I will not do that. You see the mark, and then you can do that during the viewing session. So there will be a viewing session separately, and then you just register for that, and then I will be there with you. So you see your paper, you see your mistake, and then, you can check the marking as well. Let's say that if there is a mistake, you let me know, right? And then we can all go through that in that viewing session. Is that right? So you can see your paper, of course. I'm not going to hide the paper from you. So you can check that, and you can learn from your mistake if there is any. Is it all right? But I can't upload the solutions online for you. I will not do that. Okay? Yes. Can you say again? What do you mean? Oh, you forgot to do this? But did you write your name on the paper? Okay, are you in this room? Can you send me an email after all? Yeah. Send me an email and say to me what's your name, and then you forgot to write what your color of your exam. If you can still remember that. Okay, otherwise I check later on. Hopefully there will be only one person in that room who forget to write the name, right? If I got two, I don't know which one is which. Okay. Okay, so we deal with that after all. But now we will go through the questions together. Okay, so last week you learned about cost of capital, right? And the measure of cost of capital is WACC. Wow. It's still like this. There have been problems with this lecture venue. And you may realize that we haven't got the video recording for this lecture venue for the last 2 weeks. And I'm trying to follow with the administrator, but still, So this week I've made the Tuesday one available, so at least if something is wrong with this venue, you can check that on the Tuesday one. So it should work. Okay. Can you see that? Okay. Because the pen is not working correctly, so I have to write that down here. So let me know if you can't see it. Okay? So last week we learned about WACC. Okay. Okay, that should be fine, right? So you learn about the weighted average cost of capital, and remember there will be debt, preference shares, and common shares, right? They are the normal financing or the normal financing sources of the firms. So there will be three of them. So in the formula, you can see the components of all of them. First of all, you want to see what would be the ratio or the weight of debt. So debt divided by V, I'm just writing the formula again, just to remind you, because you may not have enough time to review that lecture. So D over V times RD, right? So the weight of debt times the cost of debt. And remember, the cost of debt is before tax, so you have to convert them after tax. So this is the first component. The second component you have is preference share divided by V times RPS. And the next one is common share, or you can call them equity, divided by V RE. Okay, so this is the formula that you learned last week. Why is it important? So far we've done capital budgeting, and I've been giving you the discount rate, and then you use the cash flow, you discount it back to present using the given discount rate, right? If the discount rate is not given, how can you calculate that? In that case, you should use the WACC as your benchmark. And then if the project that you are evaluating satisfies the two criteria, the first one, the project shares the same systematic risk as the whole portfolio of projects of the firm. Okay, so if the project that you are evaluating is having the same risk as your firm, the second criteria is when your project is financed by the same mix as your firm. And then you can use the WACC, which is the weighted average cost of capital, as your discount rate, right? So let's say that if your project, or if the project that you are evaluating is having a higher risk, you will have to apply a higher discount rate than WACC. So that's what we learned last week, right? So here you have this formula. So pay attention to first. What is V? So V is the market value of the firm, and V is calculated as D plus PS plus E, right? So you know that the sum of the three weights here should be equal to 100%. Agree? So that's the first thing that you need to remember. The second thing is RD, RPS, and RE. So you need to know how to calculate the cost of different types of financing resources, including bonds or debt, preference shares, and common shares. So I'm going to go through that during our example, okay? And the third one, which is also important, is that we need to make sure that all of our costs here are calculated after tax. So you can see that RPS is already after tax. That's why we don't need to times 1 minus T. RE is already after tax. So let me just show you why it is the case. Okay? So if you think about the income statement of any firm, so we've been looking at the income statement, right? You agree with me that we start with revenue, you minus expense, and you have EBITDA, right? Earning before interest, tax, depreciation, and amortization. And then we deduct depreciation and amortization, you have EBIT. Okay? And then you minus interest, you have EBT. Right? And you minus tax, you have net profit. Right? So that's the process that we've been learning. So the net profit after tax will be divided into two parts. The first part, the firm will decide how much dividends the firm is going to pay. Are you with me? So the dividends will be paid from the net profit. The remaining net profit will be retained earnings. Okay? So far that's what we've been learning. So how do we know that it's before tax or after tax? If you look at the cost of debt, what is the cost of debt? It can be measured based on the interest. And if you look at this, interest is considered an expense, right? And then it is deducted before you calculate earning before tax. So the cost of debt, the RD that you have in the formula is always before tax. And that's why you have to times 1 minus T to calculate the effective cost after tax. Okay, make sense? And then if you look at the cost of preference share and the cost of common share up here, they are calculated based on dividend, right? And dividend is already taken from the net profit after you pay the tax. So this is already after tax. And that's why there is no adjustment is required. Is it clear for you now? So we need, in order to calculate WACC or WACC, there will be 3 steps that you need to follow. The first step, we need to calculate all of the weights, right? That's our first step. We need to calculate all of the weights. And how to calculate all of the weights? You need to calculate the market value of debt, the market value of preference share, and the market value of equity. And after you do that, you can just calculate V and calculate the weights. That's your first step. What would be the second step? You calculate after-tax cost of debt, cost of preference share, and cost of equity. That's your second step. And the third one, of course, would be WACC calculation. Is it clear now? There will be 3 steps. So now we are going to do the question together. Your question 13.24, isn't it? Okay, so now if you look at the question here, I hope I can write something on this. It didn't work before. Okay, the question asks you to calculate WACC. And you look at that, they give you $300 million of market value of debt. It is equal to D in your formula. Is that right? Market value of debt. The 9% coupon bonds semi-annual pay have a maturity of 15 years and currently priced at 1,440. So they give you the coupon rate, they give you the maturity, they give you the price. Can you work out the cost? So if you remember what we did before, right? I give you all of the 4 criteria out of the 5 inputs that you have. So basically, I give you the maturity, the discount rate, the coupon, and the face value. I ask you to calculate price. Agree? This one, they give you all of the other 4. They give you maturity, they give you coupon or payment, they give you the face value, the price, and they ask you to calculate the discount rate. So it should be straightforward to do, right? And then if you look at the next one, the company also has issue of 2 million preference shares. So you have number of preference shares, and you have market price of preference share, okay? So if you want, you can put, this one is the number of preference share. This one is the share price, right? Price per preference share. Okay? And the preference share offers an annual dividend of 1.2, so DPS is equal to 1.2. Imaginary also has 14 million ordinary share, so that is the number of common share. And the price of common share is 20, right? Price of common share is $20. The company is expected to pay 2.2 ordinary dividend 1 year from today. So they give you the dividend of common share at time 1. Is that right? And that dividend is expected to increase by 5% per year forever. So G is equal to 5%. Tax rate is equal to 30%. And they ask you what would be the WACC. So it's sort of the summary that you have here. So now we will go through 3 steps. Okay, look at the first one. What would be the first step, everyone? You calculate the market value and the weights, right? So that's your first step. So now, if you just think about that. The market value of bond is $300 million, and this one is given. If you look at this up here, make it a bit smaller. The $300 million here is given. You don't need to calculate. And you need to calculate the market value of shares, which is P, preference share, or you can put PS. Doesn't make any difference, right? So the market value of preference shares would be the market value of one share, one preference share, times the number of preference shares. And the information have been given to you. You have how many shares? 2 million. 2 million preference share, and the market price is $12 for each share. And if you calculate that, the market value will be $24 million for preference shares. This one is also easy. How about the third one? You want to calculate E, or the market value of common share, right? Again, you know the number of common shares, and you know the price or the market value of each share. And you can easily calculate the market value of the ordinary shares. Is it straightforward now? So after you can get D, P, S, and E, you can easily calculate the total market value, which is V, as the sum of D, P, S, and E. And the total market value is 604 million. Okay? So after we can calculate the market value of each component, you can calculate the weight of each component. And here we have 3 components. We have debt, we have preference shares, and we have common share. And you can do that here. D over V, PS over V, and E over V. So this one, is it all right? Okay. So now we move on to the second step. What is our second step? The cost of each component, right? You have the market value of each component, and now it is the cost of each component. So we need to go through the cost of debt, the cost of preference shares, and the cost of common shares. So we start with the first one, the cost of debt. So I just keep the question here so you can go through that with me. So we do the summary here so you can see, right? We need to work out RD, okay? So that's the cost of debt. Okay. So we need to work out RD. What do we have from the question? 9% coupon. So you know that the coupon rate is equal to 9%. Okay? And it is semi-annual, so you have to write down that is semi-annual payment. Okay? I can't touch the screen, so it's a bit, my writing is a bit messy, but that's all right. And the price is 1,440.03. The maturity is equal to 5 years, right? Oh, 15 years, sorry. 15 years. What else do I miss? Nothing. and they ask you to calculate RD. So it is semi-annual. Your coupon rate is 9%. Can you calculate the coupon payment every half a year? Yes? Can you calculate, do you know the face value of the bond? By default, it is $1,000. Can you work out the discount rate? Can you try to do that to see what is the result that you have? After the test today, I think this question is a piece of cake, right? Should get it within a minute. So see whether you can give me the discount rate. The discount rate is the cost of debt. Okay. What is the value of N that you input in? 30. What is P? How to input into your financial calculator? N is equal to 30. P is equal to? I write it first and see whether you do that correctly, okay? 1440.03. Yeah? What is your PMT? 45. See whether you can get the result if you do this. FV, 1,000. Is it correct? What's wrong? P should be your outflow, right? Remember, we say that when you input, if you consider yourself to be the issuer, P will be your inflow, and PMT and FV will be your outflow. If you are the investor, P will be your outflow, which is a negative number. PMT and FV will be your inflow. So you can do whatever way that you like, but you need to make one, either P or both PMT and FV to be a negative number. Otherwise, you wouldn't get the result. Is it good? So what is your RD? Have you got the RD yet? If you do this, and I think that is straightforward now for you to do, your RD is equal to 2.42% per half a year. Remember, because we are compounding the interest rate, or we are paying the coupon every half a year. So your 2.42% is per half a year. But what we need is the annual cost of debt, not the half a year cost of debt. So your next step would be to convert that RD per half a year into the effective annual rate per year. Can you do this? This one is also from your lecture 1 and 2. So I just show you the result. So it is going to be 4.8986% per annum, effectively. So the effective annual yield would be 4.8986%. So remember, the effective yield should be what you use in your formula, what you use as an RD in your formula to calculate WACC. Okay? So not the YTM. We care about the effective cost that the firm will need to pay. And in this case, it is almost 4.9%. That's the cost of debt. Okay, so we've done with the first part of the second step. The second part would be to calculate the cost of preference share. And if you look at the question here, it becomes so easy for you as well. Now it is the information of the preference share. Market price is $12. Dividend is 1.2. So if you think about that, right? If you draw the timeline, like what we've been drawing, this is your preference shares. And remember, shares do not have maturity. So here we will go to infinity, and the DPS, or the dividend, is 1.2. And if it is a preference share, would the dividends change? No, right? So you know that if it is a preference shares, the dividends will stay constant. So you know that the DPS of 1.2 will remain the same forever. Still DPS forever. Agree? What is the price? 12. That's the price. Okay, so if you think about that, I normally give you the dividend and the discount rate. I ask you to calculate the price. So if you recall your formula, what is it? The price of the preference share is equal to dividend of the preference share divided by RPS, or the discount rate, right? Because it is a constant perpetuity here. You can see that it is a perpetuity. It is an ordinary perpetuity. Agree? So you have this formula. So now the question gives you DPS and P. Can you work out RPS? Easy. So RPS is equal to DPS over PPS, and it is 1.2 divided by 12. And you can get the cost of preference shares. All good? The next one, you are required to calculate the RE, which is the cost of equity. How many methods can we use to calculate the cost of equity? Can you remember? At least you should remember one in lecture 2. So we do the dividend discount model, right? So you are given the cash flow of the dividends. And then now you can calculate what would be the discount rate if I know the dividends and if I know the price. So that's the first method, okay? So just write it down here so you remember. So in order to calculate RE, there will be two methods. The first one is the dividend discount model. And if you remember, we say the price of the share is equal to the present value of all of the future dividends. So dt divided by 1 plus RE to the power of t. And because it's future dividend, t is running from 1 to n. Agree? So if the question gave you the information of dividend and price, you can easily work out what is RE. That's the first method. The second method that you can use is CAPM. With CAPM, you think about the formula. The expected return of a security is equal to RF plus beta times ERM minus RF, right? That's beta I here. Okay? So there will be two methods. It depends on the question so that you know which method you are going to apply. So in this question, if you look at this, in order to use CAPM, you need to be given beta, RF, and market risk premium, or market return. In this question, do you have that information? Which method are you going to use? The first or the second? You look at the question. Is there any information of risk-free? Is there any information regarding the beta of the security? No. So it means that KPM cannot be used. You have to use the dividend discount model here. Okay? So how to use that? Again, we draw the timeline, right? You want to see this is your common share, and the price of the share is $20. P is equal to 20. The dividend D1 is 2.2. D2 is equal to D1 times 1 plus G, and G is 5%. Okay? So you can see that it is a constant growth model. So if you put into the formula, P0 is equal to D1 over R minus G. So this one is a familiar formula for you, right? And do you know D1? Yes? Do you know P? Yes. Do you know G? Yes. Can you work out R? So that's how we do, right? And then you can easily calculate the R, or cost of equity. So I show you the result. But it is a process that you should follow. Okay. So cost of ordinary equity would be D1 over P plus G. And then you can calculate that it is equal to 16%. And the third step is straightforward from step 1 and step 2, where you can simply plug in D over V, RD, tax rate, and all of the rest, and then you can get the result of WACC. Okay, is there any problem? No? Okay, so the next one, which is related to this question, I want to tell you before we move to the next question. If you look at the question that we've been discussing, and you can see that they sort of give you all of the market value, right? Not this. They give you the market value of debt. They give you the number of preference shares and the market price of preference shares. They give you the number of ordinary shares and the market price of ordinary shares. Agree? So they give you the market price and they give you the number of shares so that you can calculate the market value. Now, let's say that with debt, I don't give you this information, assuming that I don't give you that 300 million of market value. Okay? The question is, if I only give you the number of bonds, it's 100,000 bonds. Okay? And I said that with the bonds, and still equal to 15 years. Okay, just bear with this. And it's still equal to 15 years. Coupon rate is still equal to 9%. And cost of debt is equal to 5%. And face value is 1,000. What should you do? Do you need to calculate cost of debt anymore? No. What do you need to calculate? What do you think? The present value. Why do we need the present value? Why do we need the present value? Why do we need the price? Because you have to use the price to calculate the market value of debt. Is it clear? Okay, so it is similar with preference shares and common share, right? So in this question, you can see that I give you all of the information related to market value, and you are required to calculate cost. But if the question gave you the information of the discount rate or the cost of debt, the cost of equity, the cost of preference shares, what you need to do is you need to calculate the price of each of them so that you can calculate the market value. So the first step needs to be the second step now. So you have to start with the cost of debt first, and then you use that to get the price, and use the price to get the market value. So the market value will be the second step, rather than the first step as what I've been showing you. Is it all right? So you can see that all of the information regarding the cost and the market value, they are related. If you are given one, you should be able to calculate the other. All good? Okay, so now we move on to the next question. You are an external financial analyst evaluating the merits of a share. Since you are using a dividend discount model approach to calculate the cost of equity capital, you need to estimate the dividend growth rate for the company in the future. Describe how you might go about that process. Okay? So if you remember what we've been doing, we say, in order to value the shares, we still need to assume at some point our growth rate will be constant, right? So for the previous question, we say, okay, the price is equal to 20, and you have the dividend 1 of 2.2. I hope I remember that correctly. Yep, the price is 22. The dividend is 2.2, and dividend 2 is 1. Dividend 1 times 1 plus g, and to infinity, right? So the question asks you, how to calculate that g? If you are the financial analyst, that information will not be given to you. You are the one who will need to estimate what would be the proper growth rate that we are going to input. And that's the reason why you can see that different financial analysts may come up with different growth rate, and that's why they price the shares differently. We don't have an unified number or a consistent number that all of the financial analysts will come up with, right? You will think that, okay, this firm is going very well, the growth rate will be 10%. I may think that, okay, it's going to be 6%. So if we input different growth rate into our model, we will come up with different price. And our decision will be different whether we are going to buy or we are going to sell the stocks. Agree? So what guides you to estimate the growth rate? So here we give you two suggestions. So there will be two suggestions or two processes that you may want to adapt. The first one is you base on the historical data. To know how the firm is going to grow, you want to see what the firm has grown in the past. Let's say that if 10 years ago to this point in time, the firm has been growing at a rate of 5%, you may say, okay, if the history repeats, we may observe the same 5% in the next 10 years. Okay? So the first method would be we use the historical data, and we see what would be the growth in the past, and assume that it's going to be repeated in the future. Okay? The second method would be we look at other financial analysts, and we assume that they will have a better skills, and they have a better forecast. They can forecast the future of the firm rather than the past of the firm. Because the history may not repeat, right? There is no guarantee that they did very well in the past and they are going to continue to do very well in the future. We don't have that assumption yet. And what you have to do is, okay, I care about the future of the firm, not the past. And in that case, I want to see what other people evaluate the firm. Okay? So you may want to take, okay, the average of them, or you may want to follow one or the other. So here it is your own judgment of which one you are going to follow. And in reality, there might be a combination of both, where you look at the history of the firm, and you look at the forecast of the firm, and you adjust for all of this, and then you come up with one growth rate. And in fact, they can even do scenario analysis. What happens if the growth is 5%? What happens if the growth rate is 6%? What happens if the growth rate is 7%? And how sensitive your decision will be if you input different growth rate into the model, right? And assuming that you say, okay, the growth rate cannot be below 5% and cannot be above 10%. And you try to input all of them and you realize that, okay, no matter which one I input, my decision is still buying. And it means that you are confident that you can go and buy the shares. right? So in this case, remember, we use two approaches. You look at the past, historical data, or you look at the other financial analyst reports, and you see how they forecast. And you come up with your own growth rate, okay? And as I said, there is no right or wrong. Only the future can answer whether you're right or wrong, right? At this stage, no one knows. But then after it is realized, you know that whether you are good or not, whether your market sentiment is good or not, right? Okay, 13.29. This one is easy. You look at this, they ask you the cost of ordinary equity capital, or RE. As I said, there will be two methods to calculate the cost of equity, right? Dividend discount model or CAPM. Which method are we going to use here? CAPM, right? You can see that we have risk-free, we have market risk premium, and we have beta. Of course, you are going to go with CAPM. So do that together. Your shares react to the macroeconomic information 1.6 more times than the return of the market. It means that beta is equal to 1.6. If the risk-free is 4%, and the market risk premium is 6%, what is market risk premium? Is it ERM? Minus RF, thank you, right? If it is market return, it's ERM. But here the question gave you market risk premium, which is the difference between market return and risk-free. All right? So when you plug in the formula here, you have risk-free, you have beta, you have market risk premium. I don't think you need my help, right? Okay, so this one straightforward. The answer is 13.6. The last question, let's see, I think we have 4 minutes, so you can spend your 2 minutes on this question to see whether you can answer this. I give you the summary and see how we go. Suppose the cost of capital is 10%. What does it mean? Cost of capital. It is your WACC, right? WACC is given at 10%. The capital structure of 50% debt and 50% equity, it means that D over V is the same as E over V, and it is 50%. On good? There is no preference share, as you can see, because the total is already 100%. Its before tax cost of debt is 5%, which is RD. So RD is equal to 5%. The tax rate is 30%. What is the cost of equity capital, or RE? Do you think you can do this question yourself? Now you are given the WACC and all of the other inputs, and they ask you to calculate RE. Previously, you are given RE together with RD and other information, and you calculate the WACC. So if you plug it in here, WACC is equal to D over V, RD, 1 minus tax, plus E over V, RE. Everything else is given, and you asked to calculate this. Okay? Can you spend 2 minutes and tell me what would be your answer to make sure that you understand the process? easy question, but you need to be careful, right? Because it's easy, so sometimes people tend to do it very quickly. But of course, if it is a multiple choice question, you won't be in trouble if you get the wrong answer, even though you know the whole process. If it is a short answer question, as long as you give me this, you get part of the mark. So what's the answer everyone gets? 16.5% correctly. So 16.5% is the answer, and I don't think I need to show you how to do it, but at least you can practice and make sure that you get the answer here. I can show you. So the closest choice or option would be 16%, okay? So just rearrange the formula, and then you can get the answer. One more thing that you need to pay attention to is this information. They put before tax, cost of debt is 5%. Let's say that if I ask you the question, and I said after tax cost of debt, rather than before, I give you after tax cost of debt of 5%. Okay, what does it mean? Does it mean that your RD is 5%? No, right? It means that RD times 1 minus T is 5%. Is that all right? So pay attention to the word. And if I give you the after-tax cost of debt, it means that your RD times 1 minus T is equal to 5%. In other words, this information becomes redundant. You don't need to use TC anymore in your formula because it has already been included in the after-tax cost of debt. Is it good? So sometimes you can see that not all of the information will be utilized in your question. And some people, if you simply overlook at the question and then, okay, I have tax, I have cost of debt, I'm going to plug it in, and you may get the wrong number. And if it is a multiple choice question, again, that's the trick that I can make, right? So remember that you read that carefully and understand after tax cost of debt is RD times 1 minus T. And before tax cost of debt is RD. On good? Okay, so we've done tutorial 7, and now we have around 25 minutes for our lecture. So you know that the lecture will be really short, right? Do you need a break? Are you good? I give you 2-minute break. Only 2 minutes, I don't have that much time. So you can just stay and have a break of 2 minutes.
What calculations is wrong?
No, you can't sum this. Why? Why is sum this? Yeah, that's good. That's good. That's good, but up to here is wrong. Because here, it is the multiplication. You need to do this first, and you sum this. But you actually sum this and you do this, right? So this one is not.
Okay.
Okay, good?
That might be a silly mistake. And one more thing. See, the before one you showed RE, the return on equity, that is 16%. How come it's coming 16%? Let's say 2.2 divided by 22, okay, plus 0.05. It's supposed to be 15%, I think.
Let me see. 20, not 22. 20.
Okay,
so I
you have written 22 down, I think.
Yeah, I think maybe there was something wrong here because I think I put 20 and then I realized that the answer is 22. Okay, so it should be 20.
It should be 20.
Yeah, because you see the market price is 20.
20.
There might be a typo there, so I fixed that.
Okay.
Yeah? 20. Yeah, look at the question, not the solution. You know the steps, so it should be. Thank you. You're welcome. Okay. Shall we continue? So as I said to you earlier, this lecture is very short, but it's just to prepare you or to remind you of what we've been doing and then to prepare you for the next lecture when you are learning capital structure, right? So here we are learning financing. So remember from lecture 1, I told you that there will be 3 important decisions that the financial managers will make, and hope you still remember. The first one is investment decision. The second one, financing decision. And the third one, payout decision, right? So next lecture, you are going to learn with capital structure. The following one, you are going to learn dividend payment. So at least you go through all of that important one. And then lecture 11 will be M&A. And finally will be the international finance lecture. So now I just want to draw the balance sheet again to remind you. So we talk about investment decision. We talk about the asset side of the firm, right? And today we are talking about financing. Or we want to know how the firm can get funding to finance their assets. So we focus on debt and equity. So next lecture, you are going to learn what would be the optimal combination of debt and equity, and how to determine how much debt and how much equity the firm should raise. So we focus on debt and equity here, and just see. Okay. So I will talk about 4 different things today. We are going to look at corporate finance, and then we go through venture capital, at least to make you understand what it means by venture capital. And then you can compare venture capital and private equity to see the differences and the similarities of venture capital and private equity. Because sometimes you can hear from the news and then they talk about venture capital, they talk about private equity, and you really don't know what is the difference, right? The next one will be IPO. We talk about IPO. We look at the process of IPO, and then I talk to you about different institutions who will get involved into an IPO. So initial public offering, and finally, we spend only one last slide on seasoned equity offers, okay? So for this lecture, I'm going through the concepts. So just talk to you different terminologies that you're going to be exposed to, rather than giving you the details of what it means. So just only the terminology here. So the first one, we talk about corporate financing, okay? So here it is straightforward. There will be debt and equity, right? As simple as that. So the financing of the firm will be the combination of debts and equity. And if you look at that, bank borrowing is debt. Oh, okay, so I talk about that, I'm not writing that. Okay, so bank borrowing is a type of debt. How about debentures? Debt as well. Ordinary shares, equity, preference shares. Preference shares can sometimes be called hybrid securities. So what does it mean by hybrid securities? So hybrid securities means the securities that have the characteristics of both debts and equity. Okay? So for example, if you are thinking of preference shares here, even though it is an equity instrument, right? There is no maturity. The owner or the holder of the preference shares are the shareholders. What would be the characteristics of preference share that make it look like debts? Fixed dividend payments. If it is a common shares, you know that the dividends will be paid depending on how well the firm is doing. But then with the preference shares, it's a commitment that the firm is going to pay a certain percentage. Is it good? So remember, hybrid securities are the securities that have both characteristics of debt and equity. So we are saying that because the decision that your firm is making, your firm is raising capital through the capital market, but your firm is not a dominant player in the market. And that's why the price that the price of the issue is controller is determined by the market. Okay, so let me make it clearer for you. So let's say that the whole market is a small market, and I'm a big player. Okay, it means that if I issue a share, I can make a decision of what is the price, and you may have to take the price that I give you because I'm a big player. Okay, but if the market is competitive, if it is a big market, my firm is not that big enough to be able to say, okay, you have to pay $20 for my share. So it means that my firm will be the price taker. You as the market, you as the whole market will determine how much you want to pay for the share of my firms. Okay, so here what we are saying is that if it is a competitive market, and most of the time we see here is one firm should not be a big firm, big enough firm to be a price determinant. So they will have to be the price taker. But then they don't have to worry because the market is efficient. So the market will price their shares or their bonds fairly. So they will not price it incorrectly. So here are some terms that I would like you to have a look. So most of them are quite straightforward. If you look at outstanding shares are the number of shares issued and held by investors. Okay? So for example, my firm issued 100 million shares, and I sell it to the market. The market and the investors, you as the investor, are holding the full amount of 100 million shares. They are the share outstandings. Okay? Assuming that I'm buying back 10 million shares, what would be the number of shares outstanding? 90, right? So the number of shares that are held by the market, by the investors, are the number of outstanding shares. And the next one, we have treasury stocks. So I want to explain that a little bit. If you think about that, right? My firm has the authorization to issue 100 million shares, and I have already done that. I issue 100 million shares. At a share price of P. Okay? So now I decided to buy back 10 million shares. So remember, the number of shares that I buy back, the 10 million shares that I buy back, may not be retired. It means that I'm not going to destroy that 10 million shares. Okay? I'm going to keep that in a separate fund, which is called treasury stocks. So basically, treasury stocks refer to the share repurchased by the firm. So I may decide to pay cash. Okay. To buy the shares. So basically, my outstanding share would not be 100 million anymore. It's going to be 90 million shares, right? So I will have 10 million shares as treasury stocks. And with those 10 million shares, the firm can decide to reissue in the future. If in the future my firm needs the fund again, I will reissue those shares. Because I have already got the authorization at the beginning, right? I can reissue those shares. Or, if I believe that I don't need those shares anymore, we can decide to retire those shares. To say that, okay, those shares will be destroyed. My firm will only have 90 million shares. Okay? So remember, the treasury stocks are different from the retired shares. Because not all of the treasury stocks will be retired. The treasury stocks can be reissued in the future. The next one is the par value. The par value, let's say that is $10. And that's the base to calculate the dividend. So when your firm is issuing the share and you say, okay, the par value is $10. Investors can pay different prices to get the shares, right? But the par value remains at $10. It means that in the future, when the firm is paying dividend, the firm will say, okay, I'm going to pay 50% dividends. It means that each share will receive $5. Is it clear? Even though the investor may pay $50 to get that share, but the par value is always $10. That's the base to calculate the dividends. And the next part would be additional paid-in capital. And here we are talking about the difference between the share price and the par value. So if the par value is $10, you as the investor believe that the firm is going to perform really well, and you are willing to pay $50. It means that the par value is $10 and the paid-in capital is the difference, which is $40. Is it good? So assuming that you have issued the share and you put in, okay, the equity, the par value of $10, and the paid-in capital of $40, right? That's how much the firm can get when the shares were issued the first time. After the shares were issued, the next day, the share price was $60. Would it affect the firm's balance sheet? Do you reckon? Do you think the firm will change the balance sheet every day depending on the stock price in the market? No, right? Because remember, the share price of $60 the next day has nothing to do with the firm. You as the investor can sell the share for $60, but the firm doesn't have any share anymore, right? The firm has already sold all of the shares. So remember, it doesn't affect the existing balance sheet, but then if the firm decides to issue the next lot of shares, and now the firm can get $60. Is it clear? Okay, so that's related to the corporate financing and the common stocks. So now we are going to look at debt. So with the corporate debt, you need to understand the first one, which is important later on for you. So debt has the unique feature of allowing the borrowers to walk away from their obligation to pay back the loan. What does it mean? Let's say that the debt is 90, equity is 10, asset is 100, okay? Assuming that the firm is doing really badly, and it means that the firm is making a huge loss. The value of the asset is not 100 anymore. The value of the asset is 60. What would happen to the firm? Goes bankrupt, right? What does it mean? The debt holder can only receive $60, which is the value of the asset. It means that the debt holders implicitly give the firm an option to walk away from paying $90. So if the value of the asset is 110, the firm will survive, they only pay 90, right? But if the value of the firm is below 90, the firm will go bankrupt, and the debt holders will lose. Okay? And later on, you will learn that that's why we can value debt using option. Because it is the option, right? The debt holder is giving the firm the option not to pay when the value of the asset is lower than the value of the debt. The firm can just simply go bankrupt. And that's what we call limited liability. Right? Okay, so here are different types of debts. Just if you look at this, we talk about some of them: fixed interest rate, zero coupon bonds. We talk about callable bonds, so you can have a look at the terms. And this one, we already talked about the tax treatment. So basically, all of the debts, all of the expenses incurred, all of the interest expense can be considered a firm expense and will be tax deductible, right? That's why, remember, we do RD times 1 minus T, because our RD is before tax, and the effective one would be after tax, right? Okay, so convertible securities are the securities that allow the holders to convert into ordinary shares. So let's say that when you start, and then you are the bondholders. So you are the bondholders of the firm, and it is a convertible bond. It means that in the future, you will have the right to convert your bond into a number of common shares. Remember, that's the right, it's not an obligation. You will make your decision of whether you want to convert or not, right? And your decision will depend on whether the firm is doing well or not. Okay, so how about patterns of corporate financing? So most of our firm rely on internal funds. So when we say internal funds, I come back to the income statement that we did last time, and we say our net profit will be divided into two parts: dividend payment and retained earnings, right? So dividend payments will be distributed to the shareholders. How about the retained earnings? Why do we need retained earnings? Who is the owner, or who is the ultimate receiver of the retained earnings? Shareholders, right? So why don't you want to get all of them as dividend? Why do you want to leave some of them as retained earnings? For reinvestment, agree? So you can see that the retained earnings here will be added up to the equity of the firm and will be used to finance the asset, and hopefully will generate a higher growth for the firm. And that's why if the growth of the firm is very good, the firm may not pay dividends. And they may decide to keep all of the retained earnings to invest into profitable projects. And that's what happened with Apple during the first how many years, right? You see that they don't pay dividends because they want to keep that. The projects are very promising. Okay, so during the global financial crisis, what we are saying is, in order to make up the deficit, the firms can decide to borrow or to raise equity. But during the GFC, every firm is in short of cash, or they don't have funds to finance each other. And if you want to borrow, you may have to pay 20-30% per annum. It means that cost of debt is very expensive during the GFC, and that's the reason why during the GFC, they tend to use equity financing rather than debt financing. Okay, so the next part is venture capital. And as I said to you, I just want you to understand the difference between VC, venture capital, and private equity. So if you think about venture capital, if you have the money, I just started my firm or my company, and I have a great idea of doing business, and you want to invest into my firm. Is it a risky investment? It is, right? Why do you want to invest into my firm? If it is a risky investment and you invest, it means that you expected a higher return, right? It's very consistent from what we've been saying. Higher risk, higher expected return, okay? So that's with VC. So with VC, we invest into a startup company. How about the private equity? With private equity, it's a bit different, okay? So with private equity, you don't invest into a startup company, even though the similarities would be both VC and PE are very risky investment. However, with private equity, you as the investor will invest into already established firms. But then those firms are not profitable at the moment. And you expect that you can buy the firm and you can change the operation so that you can make money. Okay? So remember, PE, we buy the already established firms, whereas VC, we buy the startup firms. So with VC, you actually buy the ideas, right? You buy the idea, you buy the entrepreneur that you invest. Whereas with the PE, with the private equity, you believe that you can do better than the existing board of directors. And that's why you want to change the firm, so that you can make the money from the firm. So you can see the potential, but you don't think that the firm has been operating to the maximum potential. And that's why you buy it. Is it clear? So risky investment for both of them, but here are the trend of the PE and VC, and you can have a look at this. The next part that I will go through is the IPO, initial public offering. So with IPO, please remember that IPO is the first time the shares are offered to the public. It may not be the first time the shares were issued. The shares might be issued before, but were not offered to the public. Agree? So IPO was the first time that the shares are offered to the public. May not be the first time the shares were issued. Okay, that's the first thing you need to remember. The second thing that you need to remember is there will be two bases of underwriting contract. So first of all, you need to understand what does it mean by underwriting. So underwriters of the IPOs will have to provide financial support, procedure support, or procedure advice to the IPO firms. That's the role of the underwriters. And they can provide the underwriting services on two bases. The first base would be, they say, okay, I'm going to go with a standby basis. They will be on a standby basis underwriting. What does it mean? It means that the underwriter will commit that they will help the firm to sell all of the shares that they plan. So if the firm plans to sell 1 million shares to the market, the underwriter will say, on a standby basis, I will do that. It means that if the market didn't react very well, the market only bought 500 or 50% of that, the underwriter will have to take the risk. Is it clear? So underwriting on a standby basis means the underwriter will take the risk. The underwriter will earn the spread, which is the difference between the share price that the underwriter is paying to the issuer and the share price that the underwriter is going to achieve or going to receive from the market. That's the fee, that's the commission, or that's the spread. But they take all of the risk if the market is not reacting very well. On the best effort basis, which is the second one, best effort basis, the name can tell you that the underwriter promised that they will do the best, but they will not guarantee. It means that if the market is reacting well, it's good. If the market is not reacting well, the firm will have to take all of the risk. So they are the two differences. Okay, so one very important term that you need to know from IPO is underpricing. Okay, it is important that you need to understand. So IPO underpricing means, let's say that you as the issuer, and you set the offer price of $40, okay? The offer price is equal to $40. At the end of the day, at the end of the first trading days, the market is trading your share price at $100. If you are the issuer, if you are the current or the existing shareholders, what do you think about that? Are you happy? Are you happy with that $40 that you offered? No, right? You would wish that you could somehow set it higher so that you can make more money, because you sold to the public at $40. And now, only after 24 hours, 8 hours trading, and they are trading at $100. It means that you leave too much on the table for the other investors to earn. And it is what we call underpricing. Okay? So underpricing is defined as the difference between the offer price and the closing price at the end of the trading day. The higher the difference, the bigger the underpricing. How to avoid that? It's hard, right? Because you don't really know what the market is going to react. If you set $40 and you thought, okay, it's a fair price, but the market can react crazily and they can pay $200 at the end of the day. And if you go online, I do have some examples here, but I don't have time to show you. If you go online, you check, for example, Alibaba, and you can say that they are in China. That's the biggest one, you know, right? So during the IPO, they go up, I think, from 20-something to $60-something. So it is a huge underpricing on that day. So you can look at it happens with so many firms, and if you go to the end of the lecture slides, I put some slides for you to see that underpricing occurs in almost every single IPOs. You see that we have all positive returns here? It means that all of the IPOs have underpricing. All of them, okay? And one of the reasons we have underpricing is we want to increase the liquidity of the stock. But then too much underpricing means there is too much to leave on the table. Okay, so this is an example. When you calculate the cost, the IPO, there will be three